Everybody hand in their test? I'm thrilled to read these. Richard's false. Yeah. Shouldn't swear at the dead, should I? Terrible. Okay. Anyway, so too many things. So defining derivatives. Derivatives are really cool. They're really just anything that drives their value from an underlying asset. Could be an underlying liability too, of course, right on the other side of the deal. So yeah, that's it. So defining derivatives is just financial instruments that derive their value from the value of other assets. And what we can do is we can take assets and then we can sell rights to those assets or a future use of those assets, right? That kind of thing. And we can buy and sell those too. So you've heard of securitization, right? You take properties, right, of any kind, investments of any kind, and then you sell people interest in those investments. It's kind of sort of the same thing. They're deriving their value from underlying assets, that's all. Okay, so they've got three types: financial forwards or futures, right? And then options and swaps, right? So three different types of derivatives that we're going to mess with. So you guys read about this? Well, maybe try to find time to read it in addition to doing the exam. So if you haven't pound into this, I know it's an appendix, but it's really important stuff. And I don't know why it's in an appendix. It should be an integral part of this chapter, I think. But then I think what happened was Deck made a deal with Schrader that Schrader would cover it instead of him. Is how it ended up in 313, because it would have been part of this investments chapter. So I think I'll put it back there in the media time now that Richard's gone and Alan's going to retire next year. So anyway, it really should be in there, and they should write it into the regular chapter. But I've got the new textbook that just came out that we're going to start using in 211 rather in the fall, and they didn't change anything. So it's still the same, but they also didn't incorporate it into the chapter, and I wish they had. I think I would if I was the authors. So okay, good stuff anyway. So that didn't work. Thanks. Who uses derivatives and why? This is the coolest thing. You can dramatically reduce your risk, or you can gamble big time with derivatives. So you need to know what you're doing here. Really important. People can sell you derivative contracts and claim to you that they're reducing your risk, and really, you just got a speculative position. You got to hold a speculative position, and you could lose everything, right? Okay, or make it big, and you're rolling the dice. Or they can sell you a contract where you are hedging your bets. Called a hedge, right? So you're covering both sides of the deal, right? Well, what happens if you know what? My wife has the ability to make sure she wins every single race. She's actually done this on races before. She bet on every single horse, right? She wins. Just so you say she won a race, you know. Do you win when you do that? No. The house is taking a big cut. You can't possibly win doing that, right? It's not gonna be a win, okay? Because you're gambling against yourself, right? Okay. Well, you might want to do that when you hedge. What you're doing is you're locking in a sales price, or you're locking in a purchase price. What a cool thing. And you can do that with forward contracts, futures contracts. Okay? Pretty neat. So that's a hedge. That's reducing your risk. So are derivatives a bad thing? Of course not. A hedge is a great idea. If I'm Kellogg's, I buy a lot of corn for cornflakes, right? Would I like the certainty of knowing what I'm going to pay for the corn? Yes, I buy a futures contract. But you know what? I use corn. If Kellogg's bought hog futures, I don't think they use hogs in any of their stuff, right? Hog bellies, that's not going to do them any good. That's just gambling for them, right? Unless you use the hog bellies yourself. So that's the difference between a hedge and a speculation, really, is all it amounts to. Okay? Oh, by the way, famous Southwest Airlines made a whole bunch of money by hedging fuel. What they do, they locked in their fuel prices, and fuel prices went way up, and they won big time, right? But they were going to use the fuel either way. What if prices had gone way down? They still would have had the fixed price they planned on paying. It wouldn't have been a big bonanza for them, but also they eliminated the risk of price changes on fuel, didn't they? Right? And then all the other airlines decided to follow them because they made so much money with it, and then guess what happened to them? The whole industry. They bought futures contracts and the price went way down and they were locked into buying at the higher price. But they got rid of the variability, right? But hurt their profitability. So now they've all backed off of that, right? And there's risk no matter what you do, of course, right? But anyway, good. So producers and consumers, right? Who would use derivatives? Commodity prices are volatile. They're bouncing all over the place. A good example is agriculture, right? Weather, crop production, and general economic conditions. To plan effectively, it makes good sense to lock in specific future revenue or costs in order to run their business successfully. We like certainty if we can get it, right? The more certain we can get things, the better we like it. Kellogg's is not trying to make money off of the change in corn prices or wheat or whatever else they use, right? Grain to use. They're not trying to make money off of speculating in grain prices. They're trying to make money packaging cornflakes and selling it. That's how they're trying to make money, right? They know what their business is. Somebody else, it might be their business. Oh, by the way, the farmer too. Is the farmer trying to make money or lose money off of changes in corn prices, or would they like to have a fixed price? See, so the farmer's producing this corn. Kellogg's is buying it. They agree on the price, right? Way long in advance. And both of them have certainty what's going to happen for them, okay? Relative certainty. They're probably neither one going to go wrong. Got the idea? They have relative certainty, right? Okay, but somebody else can get in between the deal, right? Buy the corn futures, right? I'm going to buy the corn in the future from the producer, and I'm going to sell it to Kellogg's, and I can be the person in the middle. What am I doing? I'm gambling. I don't own it, right? Okay, right? Or maybe I'm an arbitreur. If I own both sides, I might be an arbitreur because I might make a profit by finding inefficiencies in the market, slight difference in the price, and I do it at a huge level, right? Millions of, how do you measure corn? What are bushels? Bushels of corn? Probably, yeah, still bushels, would be. Okay, millions of bushels of corn, right? Okay, and I go, penny, a bushel profit, but my profit's locked in. That's what arbitrage is. You can find those opportunities, you can make some really good money, but it has to be on a massive scale, of course. If you're only making a penny a bushel, got the idea? Or less, right? What would a speculator be? They only own one side of it or the other, and they're just buying, right? Buying or selling. So are they going to deliver the corn to my house or to my offices if I'm a speculator? No. So I have the obligation to buy it at some fixed price. What do I do with the corn? What am I forced to do with it? Sell it, but I don't know what I'm going to sell it for. So I commit to buy it at a certain price, and I'm gambling what? Price is going to go way up. I get to buy it at that low price, and I sell it at a high price, and I make an immediate profit, right? But what could happen to it? Price goes way down. I still buy it at the high price, and I sell it for less than I bought it for, instantaneously, right? Because I've never taken possession of the corn, trust me, I don't want it delivered to me, much less the hog bellies, right? I don't want them in my house, right? Not going to happen. I don't want the gold, I don't want the silver, I don't, whatever it is, okay? Whatever you're dealing in. And by the way, you guys, there are futures markets on everything, right? Everything anybody uses. Got it? Anybody produces and anybody sells, okay? All right? Produces and sells, anybody else buys. To plan effectively, it makes good sense to lock in specific future revenues or costs. Sure, both sides. Why not? Okay, speculators and arbitrageurs. That's it. Okay. Speculator who may be in the market for only a few hours will then sell a forward contract to another speculator or to a company. Okay, so they're rolling the dice. They're having fun with this. And then arbitrageurs attempt to exploit inefficiencies in markets. They seek to lock in profits by simultaneously entering into transactions in two or more markets. So they're watching the prices to buy and the prices to sell on the same things, right? They buy two forward contracts, and they've got a guaranteed profit because they're going to buy it for slightly less than they're selling for it. Got the idea? And you look for those opportunities. Okay, that's it. And they spend all their time searching for them, and every once in a while they hit a good one. Okay, It's just inefficiencies in the market. The market hasn't adjusted yet. Okay? You have to be careful, of course, because they could go the wrong direction, of course, on theirs. Okay? All right, basic principles. Recognize derivatives in the financial statements as assets and liabilities, because that's what they are, right? You have the right to do something, right? It has economic value, you pay for it, right? It's an asset and a liability, depending on which side you're on, of course, okay? And then this is big, report the derivatives at the fair value. And we were talking about, you were thinking about doing your paper on this, right? Fair value, really? What's the fair value of these things? And that's what's tough, is coming up with that. Okay, so it makes it a real challenging area of accounting. Well, you can imagine people are wheeling and dealing in this, trying to make as much money as they possibly can, and they want to look good in their statements too, right? So imagine what starts happening here: wheeling and dealing, want to look as good as possible, want to make as much money as possible, put a good face on it, no matter what's going on. Is there opportunity for abuse here? Fair values instead of historical costs. Anytime you get into fair value. Why does fair value work on a bill for sales securities and trading securities? If they're publicly traded, it works great. What if they're not? It's really tough to come up with the values. Measurement's an issue. And that's what's going on here. Okay? Measurement's an issue. Recognize gains and losses resulting from speculation immediately in income. Now, this is big. This is a big difference. Recognize the gains and losses resulting from speculation in derivatives immediately in the income. These are unrealized gains or losses that hit the, which statement? Income statement. Got it, guys? Okay? They're speculative, right? So yeah, you know, when you're just gambling, that's what the speculation is, right? Okay? Speculative gains and losses, they hit the income. Report gains and losses resulting from hedge transactions differently depending on the type of the hedge. Some hit the income statement and some go, guess where? Other comprehensive income. Okay? Right? And the idea is with hedging, you are not intending to have a gain or a loss. With hedging, in a perfect hedge, what do you think would happen? You'd break even, right? That's the idea of a perfect hedge, right? You may not get a perfect one, right? But a perfect hedge would be breaking even, okay? And you attempt to do that. You're trying to lock in your prices, that's all. Either your sales price, if you're the producer, or if you're the consumer using it, right? Using it in your product that you're going to produce, right? If you're the consumer, purchaser, right? You want to lock in your purchase price. So one's the sales price, one's the purchase price. And on both sides, you're trying to do that. That's all. It's kind of cool stuff, I think. All right, so here we go. What's an option? Option to do something, right? Option to buy something. Option to sell something, right? Option, okay? You can do it if you want. You don't have to if you don't want. An option, right? Okay, so this is a speculation situation. Assume that a company purchases a call option contract from Baird Investment Company, okay? Laredo shares are trading at $100 per share. The contract gives the option to purchase. So a call is what? You have the right to purchase. What's a put option? Sorry, to sell. Make sense? Call is I can call it at a certain price and get it, right? Put is I have the right to sell it at a certain price. Okay? Already got it? That's all that is. Have you done this stuff before? In some environment? Finance class maybe? Been doing them, right? Those of you doing, do you do this in the Finance 315? Puts and calls? Or maybe not, it's beyond that. All right, look, what's that?
351 you do.
351 you do, that's what I thought. I thought it was later. Yeah, okay, good. Yeah, sure, okay. So, anyways, it's not all that difficult, is it? Not really, once you figure out what's going on, right? Okay? All right, anyway, so Loreto shares are selling $100 a share. The contract gives the option to purchase 1,000 shares, referred to as the notional amount, just definitions, of Loreto stock at an option price of $100 per share. Okay? So it's the right to buy it at 100. The option expires on April 30th. The company purchases the call option for $400. Okay, it's for 1,000 shares. So how much are they paying per share? It's 40 cents a share, right? So what have they bought? It's a call option. They bought the right to buy them for $100, and they paid 40 cents a share for the right to buy them at 100, and they're currently selling for 100. What are they betting on, of course? Price going up. What if the price doesn't go up? Don't exercise the option. That's what's nice about an option instead of a forward contract, right? Forward contract, you have the obligation to buy them at that price. Got the idea? Everybody got it? So there's less risk in terms of price changes here, aren't there? But what happens to their investment of $400 if this stock is worth less than $100 a share on January 2nd, 2000, or wait a minute, on what's the date they can purchase it? April 30th, 2014. They're considered out of the money then, right? What does that mean? Your option's worthless. You throw it away. You don't exercise it. So you invest $400 and you roll the dice and you lose the whole $400, of course, right? How would they make money? They're going to buy it at 100. What does the stock have to increase to for them to get back their investment? You have to increase by what? The $400 they spent for the option, right? Okay, so what would the stock have to be worth then? Yeah, 10,400, right? Is that what it is? 100 or 100,000 plus 400. It's $100 a share, so 1,000, right? So 100,000 plus the $400. It doesn't have to go up much. 40 cents a share, right? It's $100. It goes to $100.40. They break even, don't they? Would they exercise it? Yeah, you'd exercise it as long as what? You make any money at all, right? You make any money at all by buying it, right? Okay, so as long as it's worth what? More than the $100? It's exactly 100. You buy it for 100, sell it for 100. It don't do all that well, right? So your option's still worthless. But if you can buy it for more than that, right, you might still lose money, right? But at least you recover some of it. That's all, okay? Okay, so how would you record this thing? Debit call option, right? It's an asset, credit cash. You bought an asset, right? And as long as you predict that you're going to win, right, it's a $400 asset. That's simple. Okay. So in the speculation environment, the option premium consists of two amounts. It's intrinsic value plus time value. And what do we mean by that? What's the time value of this option premium?
It's like if it were exercised now, like that's its value.
Yeah, if it were exercised right now, that would be a value now, right? And what's the time value? Do you have time to gain still? You also have time to lose, but you can't lose. All you can lose here is the amount you paid for the option, right? So, yeah, so the time value, what happens as time goes by? There's less and less time, so what happens with anything as time goes by? That option does what? It declines in value, doesn't it? Okay? Right? Less time for changing the value of the stock. Okay? That's all. Okay? So it consists of two amounts. No big deal. Intrinsic value is the difference between the market price and the preset strike price at any point in time. What do you mean by strike price? It's the price you can buy the stock at in this case, right? That's the strike price. Okay? This terminology. It represents the amount realized by the option holder if exercising the option immediately. Okay? The intrinsic value is 0 because the market price equals the preset strike price, right? Right? Now, could you buy an option to buy it for, you know, a lower number than it's selling for now? Sure, or a higher number. What would happen? It'd change the value of the option, wouldn't it? Right? Okay. The spread there, right? You're already in the money, or you're negative maybe. It's going to adjust. It's going to adjust the value of the option. That's all. Okay. Time value refers to the option's value over and above its intrinsic value. It reflects the possibility the option has a fair value greater than 0. How? Because there is some expectation the price of the rate of shares will increase above the strike price during the option term. So the time value right now is $400, right? Because 100 equals 100, right? The strike price and the market price right now are the same. So that's got to be all for time value. That's all. Okay. Additional data. So here we go. On March 31st, the market price goes to 120, right? And so what happens now? If it goes to 120 and we can buy them for 100, immediately sell them if we can buy them for 100 and immediately sell them for 120, what do we think? We're in the money, right? We're going to make money, 20 bucks a share on these things, right? Less the cost of our option. Now then, in April 16th, what happened to us? We lost some, didn't we? Got the idea? Okay, and then they have the time value and the call option. So what they're saying is, If the price increases to 120, the intrinsic value on the option contract is now 20,000. What's that? 20 bucks a share. 120 less 100, right? 20 bucks a share on 1,000 shares. That's the 20,000 that we've got. The company can exercise a call option, purchase 1,000 shares for 120, and then sell them for 120. That gives the company a gain on it of how much? Well, that's the 20,000 bucks, right? Okay. By the way, why wouldn't we just exercise our option right then? Because you don't have the right to exercise it until the exercise date. Oh, you're going to sit there and you're going to watch it go down, maybe, or watch it go up some more, right? But you're in the money now, aren't you? Right? You're in the money now. You might not be later. What happens to them then by April 16th? What day are they going to exercise these things? The 30th. So they still got 15 days to hang in there, right? Okay, or 14 days. And they've lost $5 a share. Okay? $5,000, I guess. And the time value of the call option is what? Well, everybody was real optimistic when it was going up and you had a lot of time left, right? As of March 31st. 15 days later, 16 days later, one, they're not as optimistic because it's going down, and two, there's not as much time for it to adjust. Both things are working, okay? And then the marketplace establishes these things. You're not going to compute them, right? The marketplace is establishing how good they feel or how bad they feel about this thing, okay? Right? Yes?
I think you just answered it. So the time value is always going to be given to us?
It's going to have to be, yeah. Okay, so, and there are models for computing an estimate of it, right? But it's an estimate of it, right? So, yeah, all right. Options pricing models. Okay, so that was the 20,000. Okay, March 31st, it records the increase in the intrinsic value of the option as follows. Okay, so a market appraisal, like you just said, right, determines the time value of the option is $100. The company records this change in value of the option as follows. So we think the option is now worth $20,000, right, more than when we started. Okay, everybody got it? So I'm adding 20,000 to it. Debit, call option, credit, unrealized holding gain or loss. And where does that thing go? If you're in a speculative position, where does it go? This is not a hedge, speculation. You must recognize the gains or losses as you go forward. And I think that makes a lot of sense, don't you? You're intentionally gambling. You know you are. Your shareholders should know you're gambling, right? And by the way, is it okay? Can you invest in somebody that does this? Absolutely, sure you can, right? Why not, right? You get the benefit of their skill, right? They're really good at it, okay? And their luck, both, right? Okay, so you're gambling too. So anyway, so they plug it in, right? So what is this? Yeah. Unrealized holding gain or loss, income is 100. Go to the next one. It's 300. Yeah, the company records the change in value is 300. So what happened here? At the time we bought it, it was worth 400, right? We paid 400 for the option. Now we think because time's gone by, it's only worth 100, right? Okay, there's not much time left. So we're going to reduce that, the call option, by 300, right? But we increased it by 20 for what? We were in the money by $20,000, right? 20 a share on 1,000 shares. But our option went down in value by 300. So there's two things working. Does that make sense, guys? You know, when you cut through it, it's not that big a deal, right? And it's all running through the call option. So we had a call option that was 20,000 plus the 400, right? And now we're going to lower it by 300 to bring it down to 20,100. 20,000 for being in the money and 100 for what we could sell the option for now if we sold it, okay? And both are hitting unrealized holding gains and losses, okay? And you can see over a year, within the year, why do we use gain or loss? Because it could go both ways, right? So it's kind of handy. And then when you do other comprehensive income, we always use, right, gain and loss on other comprehensive. And what they mean here by putting income is that's hitting the income statement, okay? Everybody got it? Good. Okay, the company reports a call option on its balance sheet at 20,100, like we said, unrealized holding gain, which increases net income by what, 20,100 less the 400 we had originally, right, guys? 20,000 less the 300 decline in the option. Okay, sure. So 19.7, I guess. And loss on the time value of the option, which decreases net income. Good. So April 16th, the company settles the option before it expires, okay? So I guess they did have the right to sell it before. By the way, it depends on what the option says. So then they screwed up. What should they have done with hindsight?
So it's like $20.
Yeah, right. They could have made the $20,000 and instead it's dropped down, they're only going to make the 15, huh? Right? So they kept gambling. Now you can write the options either way. You can write the options to be a specific date or to be any time, right, from the time that you purchase the option forward, right? To be either way. So you write them anyway. They're making the assumption here, obviously, that they get settled whenever they want it. So, so what'll they do? Now we've lost $5,000, haven't we, guys? But what else has gone away? Okay, I'm settling it. What does that mean? They're going to settle it when it's at 5,000. It's still 15 days before the end of it. What are they doing? What's happening? They're going to go ahead and they're going to recognize a loss on this thing, right? Okay, they're going to write it down by 5,000, 20 down to 15, right? With a reduction in value. But what's this? The option is now only 60, down from 100. They're settling it, which means they're locking the price in, okay? So, again, call option is going to go down by 40 this time, and so I've got both losses are going to add up. And if it's all within the same year, you're adjusting the gain or loss for the whole year, right? Okay, and if their year end is not in between those two, right, they'll all be in the same year. Okay, so you'd have a lot of activity going on month to month. The values change, and there it is, right? So I paid 400 for it. It went up in value by 20,000. My option goes down by 300 to 100 from 400. I lost 5 of the 20 I gained, and then my option goes down by another 400. So I got 60 on the option, 15 on the gain. Okay. So now settlement of the option contract at the end. What happens here? How much what happens to me here?
So you have acquired your.
Did I buy the stock? No, you don't need to. Right? What would happen if I bought the stock? I pay, what is their value that they're going to have per share? It's 15,000 more than the original $100,000, right? That's what this thing is worth. What's going to happen? You buy it for 100,000, you sell it for 115, right? And you gain 15 in cash, wouldn't you? Do you actually take possession of the stock and then sell it? No. They just send you a check for $15,000. Whoever's handling the transactions, right? Okay. Who's going to pay you the $15,000? The speculator who bet against you. They lost 15, you made 15. Got it? Okay. Everybody good? What did the stock go for? It was $100, right? $100 is $100. You got the 15. Okay? This all looks real good as long as you're winning, right? It's a loss if you're going the other way. And then what about the 60 bucks that's left there? Of course, that's a cost of getting your $15,000 gain in, right? Okay? So your net gain, of course, is less by the amount of what? What'd you pay for the option in the first place? 400. Cash went out. How much cash came back in? 15,000. How much did you make? 14.6. That's all, right? Okay. Pretty basic. It's just where do you put it? a period of period. Okay, so, and there it is. There's your total net income, 14.6. Isn't that lovely? Because the call option meets the definition of an asset, the company reports its balance sheet. It also reports the call option at fair value with any gains or losses reported in income as you go along. And we did that, okay? All right, so what's the difference here on a traditional versus a derivative financial instrument? Traditionally, you just buy the stock, huh? Right? Okay, versus buying an option in this case. So it has, the instrument has one or more underlyings. What does that mean? An asset or a liability underlying it that creates its value, okay? An identified payment provision, okay? The instrument requires little or no investment at the inception of the contract, okay? You don't have to pay anything for the option. They can just give it to you, right? Oh, then there would typically be what? A difference between the current market price and the option price, right? And they're trying to entice you, right, to get in the deal, okay? Sure. So it wouldn't have to be any price on it. The instrument requires or permits net settlement, okay? So good. All right. So traditional financial security, what would the payment provision be? Stock price times the number of shares. In a derivative, change in the stock price underlying times the number of shares. So what you're making is the change instead of investing in the stock price. Fine. Okay, examples of trading security, if you're selling constantly, buying and selling constantly. Initial investment, the investor pays the full cost. The initial investment is just for the option, much smaller. Settlement, deliver stock to receive the cash. Here, receive the cash equivalent based on changes in the stock price times the number of shares. So, on the underlying asset. Okay, anyway. Hedging. So what's the deal with the hedge? I'm going to get rid of, we hope, the risk of negative price changes. If I'm selling something, I'm worried about what? Price is going to go down. If I'm buying something, I'm worried about the price is going to go up. That's simple. Okay, so what would you hedge against? The use of derivatives to offset the negative impact of changes in interest rates or foreign currency exchanges is one, right? FASB allows special accounting for two types of hedges, okay? So negative impacts of interest rates and foreign currency exchange rates, we could have fair value and we could have cash flow hedges, okay? So this gets a little more complex. Okay, a fair value hedge, a company uses a derivative to hedge, offset the exposure to changes in the fair value of a recognized asset or liability or an unrecognized commitment. Companies commonly use several types of fair value hedges, interest rate swaps, and put options. Okay, so our finance folks in here can help us with this a bit. On April 1st, 2014, Hayward Company purchased 100 shares of Sonoma at a market price of $100 a share. Does not intend to actively trade it. It consequently classifies the Sonoma investment as available for sale, so it either be short-term or long-term, right guys? Depending how long you're gonna hold it. Records it as available for sale investment as follows. This is real familiar to you, I hope. Although I prefer to call it investment in available for sale securities, long-term or short-term. They're the same thing. Problem with this one is it kind of looks like what? An equity investment, which would be investment in affiliate, right? So I prefer those terms. They're all equity investments. So, but so is an investment in trading securities and equity investment. So I think they should call that available for sale, short-term or long-term. Debit, the investment, credit, cash, that kind of makes sense. Okay. Fortunately for Hayward, the value of the Sonoma shares increases to 125 per share. That's nice. Okay, so they record the gain on this thing. Now, where's the gain going to go? Available for sale? Where does the gain or loss go? OCI, other comprehensive income, right? What is the trading security? Where does it go? Income statement, right? Unrealized gain or loss on the income statement. If you're only going to hold it up to a few weeks, maybe, trading security, right? One day up to a few weeks. You're trading it, right? The gains and losses should hit the income statement because you're turning it over so much, right guys? Okay, you're turning over, so you think if it drops in value that it's not going to recover before you sell it, right? You think if it increases in value, it's not going to go down before you sell it. So you go ahead and put the gain or loss in the income statement. True? What do you do with the available for sale? You assume what? You're going to hold it long enough for the price to change again, so you don't lock that gain or loss into the income statement, you put it into other comprehensive income, right? And that was a political compromise, right? When we started, trading securities were going to be what? With this value. they were gonna be anything less than a year. And the bill for sale was gonna be more than a year. Companies didn't like that very well. Why? Because it make their earnings fluctuate with the stock market too much if they have a lot of investments. That makes sense, right? So trading securities got to be a shorter and shorter and shorter window until now it's basically a few weeks. Got the idea? So you won't see as many trading securities unless the company's obviously involved in buying and selling all the time. Okay, sure. So what's it going to look like here? Adjust the available for sale security. They call it fair value adjustment. What would that be? Debit investment in available for sale securities. Or you could use an addendum account, right, in this case. So you keep it at historical cost and then add this to it for disclosure purposes, fair value adjustment, up or down. Unrealized holding gain or loss, and notices to equity. That's other comprehensive income, isn't it? So fine. All right, here's how it's showed in the financial statements, right? So now available for sale is not the 10 we paid for it. It includes the 2,500 we gained, and we have 2,500 in other accumulated other comprehensive income. So good. All right. Hayward is exposed to the risk that the price of the stock will decline now. To hedge this risk, they lock in their gain on the investment by purchasing a put option on the 100 shares of Sonoma. So they're in a position where they have other comprehensive income, which is not hit their income statement, their retained earnings yet, right guys? They're showing a 2,500 gain in other comprehensive income. They want to make sure that gain gets where? Into their income statement, right? And then into their retained earnings. Everybody agree? That's what they want, okay? They want to avoid the risk of it going back down. So they do a put option. Hayward enters into a put option on the contract on January 2nd and designates the option as a fair value hedge on the Sonoma investment. You have to say up front, I'm doing a hedge, right? Otherwise, it's not treated as one. You have to decide in advance. You cannot decide after the fact. Why? Because then I would only stipulate the ones that worked as a hedge after the fact, and the ones that didn't work, I would just go ahead and let them be a speculative gain or loss. You got the idea? Okay, so you have to specify in advance. So we have to keep paperwork on this. Okay, all right. So this put option expires in 2 years, gives Hayward the option to sell the stock at shares at a price of $125. Now, what does that do? If the market price goes below 125, they can do what? Sell it for 125 and lock their gain in. What if the price goes on up? Don't exercise the put option. Sell it for the market price. Got it? That's it. Okay. But they're going to pay a price for this, right? Okay. Since the exercise price is equal to the current market price, no entry is necessary at the inception of the put option. Okay. They entered into the put option, but did they pay for it? No. If they paid for it, would you make a journal entry? Sure. Okay. But if they don't pay for it, they just have the option to do it. Why would somebody give them this option? Because they're gambling what? The price is going to go down, right? Okay, so good. Okay, the price of the Sonoma shares has declined. What would they do now? Okay, so they've adjusted their unrealized holding gain or loss for the 500, right? And the fair value adjustment goes down because it's now worth less. It's declined to $120 a share. Following journal records the increase in through December 31st, 15. So the put option is now worth 500, and the unrealized holding gain or loss goes down. So what did they just do? They just recognized a loss, right, on the decline in value. But then what did they do? Because the put option is saving them from having that loss, they value the put option equal to the loss. So what's the net effect on unrealized holding gains or loss on the income statement? What just happened? Loss on the income statement of 500? And gain on the income statement of 500. Right? You've hedged. That's it. You hedge against losses. Cover. Everybody good with the put option? Each of these look pretty simple as you're doing them, but when you start doing them on problems, whoa, wait a minute, what's going on? Okay, so here's the balance sheet presentation. They now have the equity investment at its new market value. We wrote it down to the market value as it went down. and we have the put option, okay? And then on the income statement, there's the holding gain on the put option and the loss on the available for sale securities, okay? So they both hit, okay? And by the way, it takes that loss and put it in the income statement, didn't it? Okay, right? Cash flow hedge. This is used to hedge exposures to cash flow risk. Results from the variability in cash flows, okay? So what we're going to report is fair value in the balance sheet, gains or losses go in equity as part of other comprehensive income. So what does this do for me? All I'm trying to do is, what do I mean by cash flow risk? What is this? What's a cash flow hedge? I'm hedging against cash flow risk. I'm going to show the fair value of cash on the balance sheet? Yeah. What are we talking about here? What's going on? And the gains or losses hit other comprehensive income. What is this stuff? Huh. What's going on with this? Here's an example. What's happening? They anticipate purchasing 1,000 metric tons of aluminum, okay? As a result, they enter into an aluminum futures contract, okay? For what? They're going to deliver to me and I'm going to buy, right? I'm purchasing 1,000 metric tons. The aluminum that gives me the right and obligation, and obligation to purchase 1,000 metric tons. This isn't an option, right? This is a futures contract, okay? Purchase 1,000 metric tons of aluminum for $1,550 per ton. The contract price is good until the contract expires January 2015, and I'm going to buy it in January. The underlying for this derivative is the price of aluminum. So as the price of aluminum goes up above that, what happens to me, really? I have an economic gain, right? I'm locked in at $1,550 and I would have had to pay more. If the price comes in below that, what happens to me? I have an economic loss. But what happens to my cash flow no matter what? This is why it's a cash flow hedge. What happens to my cash flow? How much am I going to pay for the aluminum no matter what the market price is on the date I buy the aluminum? I'm using it myself. I'm not buying it and selling it, right? I'm not a speculator. So I'm going to use this, right? I'm Allied Can. I make cans with the aluminum, okay? So what's going to happen? No matter what the market price is, higher or lower than that, or exactly that, I'm going to pay that much. So what's going to happen to my cash flow? It's going to be exactly what I planned. I avoided the risk of changes in cash flow by avoiding purchasing price change, right? Okay. That's it, okay? So Allied enters the futures contract instead of November 1st, assumes the price to be paid today for inventory to be delivered in January. The spot price equals the contract price. Okay, the price to be paid for inventory to be delivered in January equals the contract price. With the two prices equal, the futures contract has no value, therefore no entry, right? If that's the price now and you agree to the price now, there's no entry for it, okay? Okay, so the price of delivery, let's say it increases to 1,575 per metric ton. Allied makes the following entry to record the increase in the value. Okay, they've got a futures contract that went up. How many was it? How many tons did they have? 1,000. And how much did it go up by? 25 bucks. So their futures contract was nothing, but now it's worth 25 grand. Would you guys agree with that? Because you're saving 25,000 right now, okay? As of December 31st, 2014. Presumably they're your income, okay? So there's an unrealized holding gain or loss, and that hits equity, right? You've had a gain by having this contract. True, but you don't recognize it, right? On the income statement, you put it in other comprehensive income. Allied reports the futures contract in the balance sheet as a current asset, and the gain is part of comprehensive income. So fantastic, okay? So why is it a current asset? Because you're going to exercise the contract when? You have to, right? You're buying the goods when? Within the year, right? Within 1 year. So it's current. Sure, that's it. Okay. All right, on January 2013, Allied purchases 1,000 metric tons for 1575, makes the following entry. Okay, at the same time, Allied makes final settlement of the futures contract. So how does this work? Okay, I buy the inventory for the higher price, don't I? But then what happens? I get 25,000 cash back from my futures contract, huh? Right? So really, what's the net amount I paid for this thing? I locked it in at the 1550 original price, right? Okay, everybody see it? Futures contract's gone. Okay. All right. So my anticipated cash flow is for $1,550,000. The actual was $1,550,000. There are no income effects at this point. Allied accumulates in equity the gain on the futures contract as part of other comprehensive income until when? You would think they'd have the gain at the point they bought it, wouldn't you? And put that on your income statement? What do they make you do instead? When you sell the inventory. What do you adjust when you sell the inventory, of course? Your cost of goods sold is not $1,575,000. Your cost of goods sold is $1,550,000. And at that point, you have that gain. Got it? Okay? That's when you're going to realize the gain. Actually, it is when you realize the gain. Right? Okay? So you'll recognize it at that point in your income statement. All right? So that's kind of fun stuff. Turn your brain inside out. Assume that they process now the aluminum into finished goods cans. The total cost of the cans, including the aluminum purchases, is $1,700,000. Allied sells the cans for $2 million and records the sale as follows. So what happens? Cash, they sold it for $2 million, or accounts receivable. Sales revenue is $2 million, of course. Cost of goods sold is $1,700,000, right? Okay, including the cost of the purchases, right? Processing of purchases. The inventory of cans goes down. Okay, since the effect of the anticipated transaction has now affected earnings, they make the following entry related to the hedging transaction. So what happens? The unrealized holding gain or loss, it's a gain, right? So you debit it to get rid of it, and you credit cost of goods sold. You hit cost of goods sold, and you could combine those two into one journal entry for cost of goods sold, right? Everybody got it? Not a big deal. Each piece, not too bad. The gain on the futures contract, which Allied reported as part of the other comprehensive income, now reduces cost of goods sold. As a result, the cost of aluminum, including the overall cost of goods sold, of course, is the $1,550,000, which is what you agreed to in the first place. So what's the point of waiting until you sell the goods? We think the gain or loss belongs with the underlying asset, which is the inventory, which doesn't hit your income statement until you sell it and its cost of goods sold. So the gain orders, right? Wouldn't be a loss. Yeah, the gain locks, right? It's locking the price in. Okay, no, it could be a loss. I take it back. Could be a loss. When would the loss hit? But you have to buy it no matter whether it's higher or lower, right? So you could have a loss. When would the loss increase cost of goods sold? When you sold, right? Okay, sure. All right. So good stuff. So embedded derivatives. What are these things? Hybrid instrument. These are really fun, and they're having a really good time figuring out what to do with IFRS and US GAAP on this stuff, on embedded derivatives. A convertible bond is a hybrid instrument. What do we mean by embedded derivatives, hybrid instruments? The bond itself is an investment, right? But the conversion feature, you have the right to convert the bond into share stock, right? Common stock, makes the bond more valuable. So the difference that you pay for the bond when you invest in it, right, between what you would have paid had you not had the conversion feature and what you did pay with the conversion feature, that's the additional you paid for the embedded derivative, which is the conversion feature. Got the idea? Okay. And you can build a variety of different features into investments in general, investments in bonds even. That makes sense? So you could have all kinds of things embedded in it to entice people to buy it, right? To give you a better price for it, whatever. Okay? Cool. All All right, anyway, a debt security is referred to as the host security, that's the bond, and an option to convert the bonds to shares of common stock is the embedded derivative. To account for the embedded derivative, the company should separate from the host security and then account for it using the regular accounting for derivatives. This separation process is referred to as bifurcation. Can't say it that either. Bifurcation. Okay? So if you get to work on this, this is really a hairy area, by the way. I've never done it, but just talking to people who do it, it just drives me crazy. Trying to figure out what the values are of each of these estimated. Okay? All right. Qualifying hedge criteria. Criteria that hedging transactions must meet before requiring the special accounting for hedges. Okay, what would you really like to do? If the reason that you are entering futures contracts is that you want to control your prices, right? Or control your cash flow, control your prices, right? If that's the reason you're going into them, how do you want to account for it? As a hedge or a speculative investment? Obviously, it's a hedge, right? Okay. So might there be motivation for people not to really hedge, but make it look like they did in their financials? Yeah. Do you want to mislead people? So what's the idea of this gap? We've got criteria for something to qualify as a hedge. How much do you have to have hedged? Okay? So what do we have to do? We have to document, right, that it's a hedge, okay, that was our intent. And the date that you do that really makes a difference, by the way. You can't do it after purchasing the futures contract, okay? If you want it to be a hedge, what do you have to do? Stipulate in advance you're hedging, okay? And you actually document that in the agreement, okay? Risk management designation is a hedge, okay? And then we look at the effectiveness of the hedging relationship. How well did it work, okay? Is it going to work? And then the effect of reported earnings of changes in fair values of cash flows have to be disclosed. All right. So this is summary of the whole thing. Speculation, how do you account for the derivative? At fair value with unrealized gains and losses going where? Income statement, right? It's not a hedge, okay? So put options, equities on an equity security for a call or put either one, okay? Hedging at fair value withholding gains and losses recorded in income, right? So the gains and losses go to income. At fair value, accounting for the hedge, if that's his, whoops. Okay. How we account for it, at fair value withholding gains or losses recorded in income. If it's a hedge item, at fair value with gains and losses recorded in income, okay? And a common example, put option on hedge on an equity investment that we just looked at. For cash flows, at fair value with unrealized holding gains and losses from the hedge recorded in other comprehensive income. So big difference, right? Income statement versus comprehensive income. And reclassified in income when the hedge transaction, I did not touch that. And reclassified in income when the hedge transaction cash flows affect earnings. That's a cost of goods sold example, for instance, okay? All right, so it depends on what kind of a hedged item it is. Use of a futures contract to hedge a forecasted purchase of inventories. So that's an example. All right. Okay, so this is another appendix in a few minutes. Let's talk about these two a little bit. Okay, you guys know about variable interest entities in general? What did these used to be called? Back in the Enron days, World of Common days, Enron was big on these. Special purpose entities, we changed the name, right? Okay, changed the name because that was a native thing back then. Okay, so what is this about? Consolidation, where you have variable interest entities. Okay, two models for consolidation. One is voting interest. If a company owns more than 50% of another company, then you consolidate in most cases, and the idea is of the voting stock. What if you don't own voting stock? What if you own more than 50% of the total equity of the company? that you don't vote, what would happen under the voting law? Like Brown-Forman, for instance, has two types of stock, Class A and B, I think they call it. The family owns Class A. Everybody else who wants to invest in the company has Class B. Class B does not vote. Oh, why'd they do that? The family wanted to maintain total control, and they wanted to raise money in the stock market. Who would buy Class B stock? It's like buying preferred stock or something, sort of, isn't it? Don't get to vote, right? But it's still common ownership, and you share in the earnings. It's a very profitable company. It's extremely well run. If you don't want to run it yourself anyway, what difference does it make if you own voting stock? What do you do with your vote anyway? I have an interest in all sorts of companies, probably. I actually have votes. Minuscule, 10 shares out of 5 million, my vote matters, right? So I don't even know what I own, right? But theoretically, I have that, and my proxies are automatically given to somebody, right? Who votes, right? Mutual fund has my proxy, right? They vote, or they give the proxy to somebody else to vote, right, guys? Okay. So the risk-reward model, if a company is involved substantially in the economics of another company, then consolidate. That's kind of an interesting one too. So different ways of looking at consolidation. Okay, so consolidation of variable interest entities. A variable interest entity is an entity that has one of the following characteristics. Insufficient equity investment at risk. What does that mean? We don't have any equity, and you're doing business with them. So they don't have any money in the game. Stockholders lack decision-making rights. They don't run the company. They're just a separate entity. Stockholders do not absorb the losses or receive the benefits of a normal stockholder. So you might have a situation where they get a percentage of the gains, but they get none of the losses, right? So these aren't really risk-taking businesses, right? So what should you probably do with these? Very small ownership taking risk, maybe. Maybe only a couple percent is at risk. The rest are not. Okay? And that percent that is at risk is owned by the company that is thinking about whether or not they should consolidate. So I own 5% of the other company, right? But I have all the votes. Or I have all the money in the game, all the investment. What should you do? Just logic to tell you what. Consolidate, right? You got control, and you got all the money at risk. If you got both of those things, and here's what was happening back in the Enron days. They really got carried away with it. They had Fastow, who was their financial vice president, set up special purpose entities with his money that were guaranteed not to lose any money doing business with Enron. And then he transferred the debt to them and the losses to them. Enron got the assets and the profit, but he was guaranteed not to lose any money on his investment. Was he a related party? Yes. So was that the same thing as Enron investing? Yes. But what he claimed was he'd gone out and he found a few percent, right, of outside investors to put real money in of their own money. Even if they'd done that, if Enron's running it and Enron's taking all the losses, do you think it should have been consolidated? Yeah. But the rules at the time were they didn't have to. These have tightened up a little bit, right? So when you have this situation, what happens? You ask this question, right? Is it a variable interest entity? So if there's inadequate equity, yeah. If no, then you go to do investors lack control. If they don't have control, it's still a variable interest entity. And then investors do not absorb losses or receive gains. They're not really a player in the thing. If yes, it's a variable interest entity, and if not, it's not one. Okay, so what's the big deal? Is the entity a primary beneficiary if of the variable interest entity. In other words, are they getting benefit from doing business with them? If that's your company. If so, you consolidate, okay? And if not, now you don't have to, okay? So do you have a number of ways that or a couple of ways at least, that you can get out of consolidating? Sure, all you have to do is decide it's not inadequate in terms of the amount of equity interest, right? You have to decide that the investors do have some control. You have to decide that the investors do have some risk, right? They're going to get gains and losses. Okay, so you end up over here. Or you can say, well, I'm not a primary beneficiary either. So you've got both routes that you can go and you can avoid consolidation still. But it's a lot tighter, right? A lot tighter than it used to be, which is good. Okay, so what's happened in practice? Okay, so here we go. The impact of the rule involving risk and reward. A study of 509 companies with total market values over 500 million found that just 17% of companies reviewed have a material impact. What do they mean by that? The company that might be a variable interest entity doesn't have a material impact on me. Hit 51% of the time. So what do you do then if it's not going to have a material impact on you? Don't consolidate. Oh, I got out of it anyway, right? Okay. No disclosure at all, 13%. Material impact, 17. Impact not yet delivered. So what happens? Most of them are not being what? Consolidated still. Okay, and that's the points that the authors are making. We tried to fix this, and did it get fixed? Probably not. They tried to tighten it up. Okay, this one's on fair value reporting. We all know that the FASB thinks it'd be a really good idea, right, to report things at fair value. Why don't we? Think about this one again. You finance guys in here. What's a big criticism of historical or of doing subject accounting principles? Historical costs, right? Okay. What do? We have a whole bunch of these assets at historical costs. We even have depreciable assets at historical costs, less depreciation or less amortization, don't we? Okay. We got land in here, no matter how long we've owned it. Warehouses are land they bought back in the 1930s during the Depression, on their books. Stands of timber they bought back in the 1930s, on their books, right? At what they paid then. We never revalued it. It's all at historical cost. So, you guys are the finance guys. Is this useful information? I think not, right? This isn't quite so bad, but it's historical cost too, isn't it? Right? In case of bonds, amortizing discounts or premiums, right? Historical less amortization. All right? And this is a ridiculous number, right? This is historical cost earnings. Does it have anything to do with market value? No. So what would be better for financial statement purposes? What is much more useful information? And when we got you guys doing WAC CAPM, that's part of the idea that you should start thinking about this, okay? What is really more of value here? What would be more useful to have in terms of the equity? How about the number of shares? Just did it with the 211 students. Number of shares times what? Market value per share. Okay, I would agree that's what the equity is worth. I would also state that that's worthless to put on a financial statement. Why is it worthless? Because everybody knows what it is and it moves every day. Changes daily, right? Could we estimate the market value of these? I know when we're doing WAC CAPM, we use a proxy, the book value. But could you estimate the market value here? Shoot, if it's bonds, you guys could go look up the trading price on the bond, couldn't you? You could put it in there. If it's mortgages, could you determine what the interest rate would be today? And then discount the future cash flows based on the interest rates you have, just like valuing a bond? Could you value every single debt you have? Could we even do the same thing with accounts payable and accrued liabilities? Could we discount them back to now based on when they're going to be paid off and our cost of capital? Sure. So you could come up with an estimate here of the market value. We know what the market value is there, what the market thinks it is. Could we add the two together? And then we have the market value of this one go in this direction, right? Of course we could. And this would be the fair value of everything. I think that's a great way to go. Here's the problem with it. What you'd have to do is figure out an estimate of each one of those assets. What is that timber with land underneath it that Weyerhaeuser owns? Out in the Cascade Mountains. What's that worth now? How could they find out what it's worth? Sell it. Timber, cut it, sell it. Land, sell it. Right, guys? What's it worth? I don't know. They don't know. And they have no intention of selling. What do we do? I guess we have to come up with some method to allocate this market value number we have in total, right? Across all the assets we own. And then what we can't identify as an asset, we would have to call what? What's the plug we have when we buy another company? We buy all of their liabilities. We assume all their liabilities and we buy all their assets, right? So we bought their net assets, which is their equity, right? We bought it all. What do we call the excess we pay over the fair value of the assets less the fair value of the liability? Goodwill. And we would have a big number of goodwill, and we would estimate it every year, and we would write it down in a balance sheet, and I would propose to you that that number is worthless, because we don't know what it is. Okay, so let's go back to why we're doing financial statements. That's kind of what this sort of thing is. Why do we do a balance sheet and income statement? What do people use them for? It's a little bit of additional information. Actually, it's a lot of additional information compared to having nothing, right? It's the information we've got to try to estimate the value of the stock. And therefore, the estimate of the value of the liabilities, the estimate of value of all the assets then, and the estimate of how much goodwill I'm willing to pay when I buy the company. Premium, right? Over the market value of the assets. What is goodwill? Future cash flows that are in excess of a business that doesn't have it, right? All discounted back to net. That's what it is, right? Why does one company have more goodwill than another? They have more future cash flows. And they're less risky. Combination, right? A lot of future cash flows, real risky, not very valuable, right? Less future cash flows, less risky, maybe even more valuable. You got the idea? Right? So it's a combination of the two, isn't it? So we are using the balance sheet and income statement to predict future cash flows and to evaluate the riskiness of the company over and over and over and over. Is it a good idea to give people fair values when we know what the hell they are? Yes. So what do we do on trading securities and a bill for sale securities? Give it to them. What do we just do when we were doing derivatives? Give it to them. If we know what they are, let's use them, right? Every time. The IFRS model tends to try to use more fair value. US GAAP tended to try to use less. Why? What do they say here? FASB believes fair value information is relevant for making effective business decisions. Which is more relevant? Fair value or historical cost? Fair value, every time. Okay, which is more reliable? It's more faithful representation, we now say, right? But reliability. Which is more reliable? Probably historical. It might be worthless, but it's reliable. And unfortunately, we go there, right? I think that's kind of crazy. I do like disclosures for land, building, and equipment to attempt to give people fair value, but I prefer them in the notes. You know why? I don't know what to do with the gain or loss. It's all unrealized. I guess it'd all be another comprehensive income, huh? We could do that. You know, we could leave the equity alone, retained earnings and stock, right? Equity, paid-in capital and retained earnings, and we could have other comprehensive income just be this number that bounces all over the place as fair values change. Anyway, so they say, yeah, it's better. Other concerns expressed about fair value, others express concerns based on two reasons. The lack of reliability related to the fair value measurement in certain cases, yeah, and the ability to manipulate. I always like to tell you guys that my wife and I bought our little house for $170,000 or something 10 or 12 years ago, and I hereby decree it's worth $1 million. Why not? How you do a personal financial statement? You're supposed to put in what the fair market value is. Do you think it's worth $1 million? No. Is it worth 200? I think it might be. Right? We paint and stuff. It looks better, so it might be better. Right? Same house, basically. Right? Is it worth 180, 190, 200, 210? What's the number? I don't know. When will I find out? When I sell it. What would be the journal entry if in my personal financial statements I say it's worth $1 million? Of course, hopefully no banker would ever buy into that, right? They'd probably look at what I paid for it. Oh, you mean the historical cost might have something to do with what it's worth now? Yeah. Is it the same thing as what it's worth now? Of course not. But do we know what has happened in the Louisville market over the last 12 years, or whatever period of time I've had. Appreciation's been about 2% per year for that time. Could we take 170,000 and compound it at 2% for 12 years and find out about what my house is worth if I've taken decent care of it? Yes. It depresses my wife when I tell her that. I'm paying rent. It's not an asset. Well, it's an asset. It's just not one that earns anything, right? It doesn't earn anything. Okay? So anyway, the ability to manipulate, you can call it whatever you want. That's their whole point. Okay? So that's kind of fun. Disclosure of fair value, both the cost and fair value of financial instruments are to be reported in the notes to the statements. We show both. FASB also decided that companies should disclose information that enables users to determine the extent of usage of fair value and inputs that used to implement fair value. So sure, all right. 2 reasons for additional disclosure beyond the simple itemization of fair values are differing levels of reliability exist in the measurement. So how good are the measures? You should communicate that. Changes in the fair value of financial instruments are reported differently in the statements depending upon the type of instrument involved, whether the fair value option is deployed. Yeah, sure. Okay, you've seen these before, I bet. Levels of reliability. Level 1 is the most reliable measurement of fair value. It's based on quoted prices in active markets. What is the share of General Motors selling for, right? This is real strong. Level 2 is less reliable. It is not based on quoted market prices for identical assets and liabilities. Instead, it may be based on similar assets or liabilities, right? So mine is privately traded, but it's a real similar company to the one that's publicly traded, and maybe I could get an idea of the value of it. Okay, that might not be bad, okay? Level 3 is least reliable. It uses unobservable inputs that reflect the company's assumption as to the value of the financial instrument. What Enron did was they created securities themselves and then they valued them themselves. They created them, sold them to themselves, and then they wrote them up to fair value. And they just decided what the fair value was. And this didn't stop. Ugh. So that's ugly, right? Really ugly. I mean, who did that? A lot of people think the auditors they had out there, a bunch of young people like you guys, didn't have a clue what they were doing, what they were looking at. But how to get past the partners and managers and partners? I don't know. I just don't know. What you look at, you guys. Yeah, so I've talked to people who used to be Arthur Anderson partners who can't figure it out either. Oh my gosh, this is ridiculous, right? But you get in the thick of it, and there's millions of transactions, and the company's making all kinds of money, it looks like, and they're all living real large. It must be real, huh? It's got to be real. So maintain your professional skepticism. At this level, who cares? Use historical cost, I would think. Okay, and then here's the hierarchy, of course. On trading securities available for sale, what do we think? We're going to use quoted market prices, right? Okay. Derivatives, well, a little less so, probably, right? Venture capital investments, yeah, here we go. What's it worth, right? So, they're investing. By the way, on venture capital investments, they expect really high returns. How come? Look where it's at over there. You don't know what you're investing in, right? You don't know what the risks are. So what do you want? Massive return. Massive return. Okay? So you're going to deal with those guys. You better be ready for that. Okay, so anyway, enough for today. Huh? That's another one they have on impaired assets, how to expose fair values. So what should we work on next time? Do some of the problems on this? Good? You want? Yeah. Yeah, well, somebody bring their book because I don't have the problems because I couldn't find my chapters. So that's the problem with a loose book, huh? My book disappeared. I probably gave it to Deck or somebody. Maybe you gave it to Schrader. That might have been where it went. Okay, anyway. See you guys.